And on Google, on the fundamental side, right? I mean, it just couldn't have played out better than I would have thought. Like everything accelerated in Q1. Search and other came in above consensus. It was about 14.4% growth. I was at 15, but the street was lower, so I'll take it. We've been calling this out for months, and it's a big reason why we've held the line on the long side. Especially given, especially relative to consensus estimates that were calling for a deceleration this quarter, right? Like, so as we talked about in terms of our process and the reason why we're like focusing and honing in on Google specifically is that, when I have data that shows that things are accelerating and I think the street's mismodeling numbers and they're actually calling for a deceleration, like you take that shot like all the time, pretty much. And that's what I've done historically, and it usually works out, and it worked out again this time. YouTube accelerated, the cloud business, GCP accelerated, they're monetizing AI. And really more importantly, margins beat. Operating income had a big beat by nearly $3 billion this quarter. It's something that we flagged going in, right? That the street was mismodeling expenses sequentially. A lot of that driven by Sunday ticket amortization and elevated subscription growth from YouTube, but also Google One subscriptions and then Workspace with GCP. So they also, had seat expansion growth as well. So that was helped driving the cloud business. And then, just on EPS numbers, broadly, and like estimates are going higher because of the big operating profit beat. They also announced, expanded buyback, a dividend. There were so many concerns around AI, and while it was tough, right, especially when the stock was going down, but it was just like we said, like this is narrative over numbers. This is not reality. That they are structurally advantaged when it comes to being able to monetize AI. And so we're seeing that. We're seeing incremental monetization from those AI investments. They're spending more on CapEx, so numbers are going higher. And on that front, but the big difference is with Meta came out and said, yeah, we're going to ramp CapEx up, but we're not going to have any revenue to show for it for multiple years. Google is spending on CapEx, but they have revenue to show for it. They have an ability to monetize that investment today, which is a really, really, really big difference. So just kind of taking it back to the numbers and where we think the stock goes, street EPS estimates were for $6.70 on the GAAP basis coming into this print for 24. We were at $7.42, so we're above the street. This morning, street numbers are going closer to 732. For 2025, we were at $8.77. The street was at 782, and now they're at $8.30. But now, after updating our model, like I think we have line of sight into $9 at least in 25 and potentially $10 in 26, which it's already April, right? So 6 months from now, people are going to be rolling forward their models and looking at 2026 numbers. So you put a 22 times multiple on that, which is within the historical range. I think it's reasonable given the quality of the business. It's supported by the cash flows and the capital return strategy. And I think, you get a stock that's between $198 and $220.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.